Welcome to another Options Trading Minute. I'm your host, David, and the information provided here comes from Jason Ayers, President for OptionsSource.net, an official provider of education for the Montreal Exchange, various financial institutions, investment dealers, and individuals who want to trade like the pros. Today we're going to discuss the simple strategy of buying calls and puts on ETFs. Now remember that exchange-traded funds offer the investor the diversification of a mutual fund with the liquidity of a stock, containing investments designed to replicate the performance of market sectors, bonds, commodities, or specific indices. An ETF tracks the net asset value of the underlying investments. There are several exchange-traded funds trading on the Toronto Stock Exchange that have options listed on the Montreal Exchange. In order to use options effectively, we need to understand the basics. If we expect the exchange-traded fund to strengthen, we can buy the shares, or, as an alternative, we can buy a call option that gives us the right to own those shares at a specific price for a specific time. Conversely, if we expect the ETF to weaken, we can sell or short the shares, or we can buy a put option that gives us the right to sell those shares at a specific price for a specific time. Remember that we can buy a call option as an alternative to buying shares in an exchange-traded fund. The value of the call option will increase as the value of the ETF increases, allowing the call option holder to profit. Since we cannot lose more than the premium paid for the option, using a call option as an alternative to buying shares allows us to participate in a bullish opportunity with a limited and identifiable risk exposure. When buying a call option, we can purchase a one-call contract for every 100 shares that we wish to control. We are in fact paying for the right, not the obligation, to buy those shares at a specific price, known as the strike price. We can sell it at any time to lock in a profit or cut our losses. This right is valid for a specified period of time. As an option buyer, we can select a time frame that suits our objective. Let's look at the Horizons Veda Pro S&P TSX 60 Bull Plus Fund, or HXU. Remember that this exchange-traded fund replicates the results of the TSX and S&P 60, 200%. Let's say the shares of HXU are trading at $8, and our expectations is the S&P TSX 60 is going to perform well over the next 4 months, with an upside target of $14. We can buy HXU shares, or we can access the HXU options on the Montreal Exchange and see that a call option that gives us the right to own HXU at $8 for the next 4 months is valued at $1.60 per share. Since each contract controls 100 shares, we will pay $160 per contract. If we wish to control 1,000 shares, we can buy 10 call options for a total cost of $1,600. In this scenario, we are optimizing our risk versus reward ratio. We benefit from 100% of the upside potential for the next 4 months. However, we have quantified our risk since we cannot lose more than the amount we paid for the call options. If we are correct and the HXU hits $14, we have the right to buy the shares at $8 and sell them at the current market value of $14, a gross profit of $6. This increase in share value will be reflected in the option price. The $8 strike call option will now be worth at least $6 or $600 per contract. Since we paid $1.60 per share, or $160 per contract, we recognize a profit of $4.40 per share, or $440 per contract. Remember, we can sell this call option any time before expiration. Again, we purchased 10 calls that gave us the right, but not the obligation, to own the shares at $8. Since we paid $160 call per contract at 10 contracts, our cost was $1,600. We can sell the 10 calls, which have increased from $160 to $600 for a total of $6,000. To determine our actual profit, we subtract the original cost of the 10 call options, which was $1,600, from the new value, which is $6,000, for a total profit of $4,400. If we anticipate a decline in the S&P TSX 60, we can buy call options on the HXD. Remember that the HXD reacts opposite to the S&P TSX 60 and will increase as the S&P TSX 60 declines. By purchasing call options, we can potentially profit as the share value of the HXD goes up, equal to 200% of the decline in the S&P TSX 60. You can use put options as a means of protecting the sale price of the stock you own, or you can use them as an alternative to shorting. By using a put option, we can profit with a limited and quantifiable risk exposure if the share value of the ETF drops. Similar to buying a call option, we would buy one put for every 100 shares we would like to control. We are essentially paying for the right to sell those shares at a specific price, known as the strike price, regardless of how low the ETF trades. The put option will increase in value as the ETF drops. We can sell that option at any time to lock in a profit or cut our losses. This is a contract and is valid for a specific period of time. Let's use the Horizons Beta Pro S&P TSX 60 Bull Plus funds, or the HXU, as an example again. Remember that this exchange-traded fund replicates the results of the TSX S&P 60 by 200%. Let's say the shares of the HXU are trading at $8, and our expectation is that the S&P TSX 60 is not going to perform well over the next 4 months. We have a target to the downside of $5. Checking the options on the Montreal Exchange, we see that a put option gives us the right to sell HXU shares at $8, or at an $8 strike for the next 4 months is valued at $1.50 per share. Since one put controls 100 shares, each contract is worth $150. If we buy 10 puts, it will cost us a total of $1,500. By choosing to use a put option instead of shorting the HXU, we have optimized our risk versus reward ratio. We benefit from 100% of the upside potential for the next 4 months. However, we have quantified our risk since we cannot lose more than the amount we paid for the call option. If we are correct, and the HXU drops to $5, we have the right to sell HXU shares at $8 and buy them back at the current market value of $5. The decrease in share value will be reflected in the option contract value, resulting in a gross profit of $3. We originally paid $1.50 or $150 per contract for the put, which represents a net profit of $1.50 for an additional $150 per contract. To review, we purchased 10 puts that gave us the right but not the obligation to sell the HXU shares at $8. Since we paid $1.50 or $150 per contract and we have purchased 10 contracts, our cost was $1,500. We can sell the 10 puts, which have increased from $150 to $300, for $3,000. To determine our actual profit, we subtract the original cost of the 10 put options, which was $1,500, from the new value, which is $3,000, for a total profit of $1,500. If we anticipate a rise in the S&P TSX 60, we can buy put options on the HXD. Remember that the HXD reacts opposite to the S&P TSX 60 and will decrease in value as the S&P TSX 60 moves higher. By purchasing put options, we can potentially profit as the share value of the HXD goes down equal to 200% of an S&P TSX 60 rally. Options are a powerful tool for speculating on ETF opportunities with a limited and identifiable risk exposure. We can control ETFs with less capital than it would take to buy the underlying shares, offering an increased percentage rate of return. We can use options inside and outside our RSPs or 401s to generate cash flow, protect and preserve our capital, and speculate on the market movement in combination with an ETF, or simply buying and selling the options that allow us to control the underlying ETF. That's it for now on buying calls and puts on the ETFs. Thank you for watching.